Hello, this is Sean Cornell of Cornell Capital Group. Today we're launching a new series of videos entitled Reflections on Investing. And these videos will feature insights and analysis from Cornell Capital Group's Senior Advisor, Professor Bradford Cornell. So without further ado, here is the first video in the series called Why is the Market Surprised? I hope you enjoy it.
Hi, I'm Brad Cornell, Senior Advisor to the Cornell Capital Group. Sometimes students and investors ask me, how do you explain the current long-running bull market? It's been 12 years now since the market turned up in March of 2009, and it's been pretty much a steady rise, except for a few blips, which were quickly replaced by new highs. How do I explain this? Well, I'm not sure that I can, but I can give you an analogy to help think about it. I play this game with my dog. I hide behind the door, then I jump out, startle him a little. He gets very excited and runs around. I then go back behind the door, wait a minute or two, and do it all over again. And after we've done this 4 or 5 times, the dog starts to learn that, hey, he may be behind the door. I expect him to jump out, and he's not quite so excited anymore. Well, why do I tell you this story? I think it sheds some light on the way the market's been behaving and the way the financial media have been treating the market, which is every bit of good news is treated as if it's new news, as if it's startling, just the way the dog treats every time you jump out as a new event. And here's the problem with that. Markets are supposed to be smarter than dogs, and let's hope they are. And they're forward-looking. The current market price of a stock reflects what investors expect from the company over the years and even decades ahead. And during the last 3-4 years, those expectations have become more and more optimistic. So you would think eventually, like the dog, the market would say, we've already assumed that there's going to be tremendous growth. If you look at a company like Tesla, we're pricing it at $650 billion because we think it's going to have astounding growth. And then it has mediocre growth, and that's treated as good news. That's the surprise. And part of the problem is that the financial media always compare current performance with past performance. Well, that provides some information, but it's not really what an investor needs. What an investor needs is information about currently what is happening compared with what was expected to happen. And here's where we seem to have gotten lost. That is, the current prices reflect extraordinary expectations. Then news is announced. It's better than the past, but worse than the expectations. And yet the price goes up again. And that's the mystery. And the question I'm asking myself is, how long can that go on? How long can people like my dog keep being surprised by every tiny bit of good news, even if they've already priced the stock on the basis that the news would be even better? So what's that all mean? Well, I can't tell you for sure, but one thing it makes me very worried about is a substantial break in prices. If somehow those expectations are not met, and then people go back and revise what they believe and throw out not only the current news as being bad, but revise their expectations for the years and decades ahead, we could have a substantial drop in equity prices. What could cause such a revision? Well, if you had the actual, could predict that, you'd be, of course, a billionaire. But one thing I think you should keep your eye on is inflation. Given everything that's happened, a substantial bump in inflation could be the match that starts a fire. we'll see. I hope you found this video helpful. Look forward to talking to you in future videos.